Hi, everybody, and welcome back to Chapter 14. Here we're going to take a look at stockholders' equity. Our learning objectives include one here, describing the corporate form of governance and issuing shares of stock. And then in number 2, describing the accounting and reporting for reacquisition of shares, treasury stock. And number 3, explaining the accounting and reporting issues related to dividends. And finally, number 4, indicating how to present and analyze stockholders' equity. Okay, as we preview the chapter, first we'll take a look at the characteristics of a corporation, how you form a corporation, the components of equity, and common stock and preferred stock. If we look at reacquisition of shares, we have treasury stock, how we purchase them, how we have the sale of them, retiring stock, etc. Dividend policy, we'll take a look at the financial condition and dividend distributions, the types of dividends, and stock dividends and stock splits. And then as we present them, how are dividends presented and a decision analysis associated with those dividends. All right, let's get into the meat of the chapter. Here we're going to describe the corporate form and issuing the shares of stock. So taxation plays a big role in this process. C corporations are your big corporations, General Motors, Chrysler, Walmart. Those corporations are C corporations. And those corporations pay income taxes on the corporation earnings themselves. And second, the C corporation pays dividends to stockholders. Those dividends are not an expense. The corporation does not get to deduct that. Then when those dividends are distributed to the stockholders have to pay income tax on those dividends. So we often say that's double taxation, because it results in earnings being taxed at the corporate level and then again at the individual stockholder level. In an S corporation, the corporation itself pays no income tax, but the taxable income from a corporation is taxed directly to the S corporation's stockholders. The number of stockholders for a C corporation doesn't have any restrictions, while an S corporation is limited to 100 stockholders. So if we look briefly at how businesses are organized in the United States, by far, sole proprietorships and partnerships account for over 80% of those organizational forms. S corporations, 13.1%, and C corporations, 5.8%. Okay, advantages of corporations. Limited liability. If you invest in a corporation like Johnson & Johnson, the most you can generally lose is your investment, the value of your stock. So very limited liability. Any losses, negligence, lawsuits, etc. to the corporation are not your responsibility. It's a separate legal entity, and it can have contracts and everything associated with it. And I think of a corporation as being a person. It can enter into those contracts, borrow money, get into legal disputes, etc. And okay, I think that's clear. Ease of capital formation. If the company needs to raise capital, it can issue shares of stock. It's the primary reason that a corporation is formed. The stockholders can then determine their interest in the company. If the company only has one class of shares divided into 1,000 total shares and you own 500 shares, then you own 50% of the company. But if you own 10 shares, you only own 1% of the company's outstanding shares. So shares trade in the marketplace, and the owner of those shares can determine the value of those shares when needed. A wealth of information is generally available to help investors make their financial decisions. Unlimited life. Because corporations generally have perpetual lives, companies like Disney, Verizon, and PayPal will not be affected by changes of ownership. Walt Disney, for example, passed away many years ago, but Disneyland and Disney World still exist. All right, as a stockholder, you don't need to worry that the corporation will end if the current management is replaced or if other stockholders sell their shares. Transferability of ownership, pretty easy to understand here. Ownership in a corporation is easily transferable. You just sell your shares. If you have shares in Google, you can sell them to others without obtaining any consent of the company or other stockholders. Each share is your personal property and you can do with it as you see fit. And then professional management. Although you may technically own part of a corporation as a stockholder, it is unlikely you're going to be involved in any day-to-day activities of the corporation. Professional managers can and are hired who have the skill and knowledge to run it. In my case, I worked for corporations most of my adult life. You may not be a microbiologist, but you might be able to invest in a biotech company like Moderna or Merck. Okay, the disadvantages of the corporation are significant. Forming a corporation, we'll start with taxation. I'm sorry, as discussed earlier, stockholders are subject to double taxation. But forming a corporation, and I've done that with a couple of nonprofits that I have been a part of, it's no small deal. It requires substantial documentation and is expensive and time-consuming. The corporate law requires more formalities in how a corporation is managed. So, for example, shareholder and director meetings are required in which proper notice must be given and minutes kept. Corporation laws also tend to have stricter record-keeping requirements. But the big disadvantage, at least in my mind, is regulation. Corporations, especially C corporations, are heavily regulated by the government. SEC reporting, for example, it's a massive job. Those SEC reports are issued at least once a year, and they're over 100 pages normally. They're also generated quarterly, et cetera, et cetera. Additionally, SOX, Sarbanes-Oxley, added to the fund in the early 2000s, and more regulation was imposed. So that depends to some degree on the state in which you're incorporated and to the states in which they do business. In addition, the federal government is often involved in issues such as antitrust, privacy, and environmental concerns. Okay, separation from management here. One of the advantages is that professional managers, in coordination with the board of directors, manage the company. Generally, the objectives of the stockholder are the same as management. Unfortunately, management may, in some cases, use questionable accounting to enhance their compensation bonuses in many ways, or even engage in fraudulent activities. All right, state corporate law. The articles of incorporation are dependent on which state that incorporation is desired. In my case, I incorporated in the state of California. It wasn't because taxes weren't an issue with a nonprofit. I could do that. However, the state issues the corporate charter here. The advantage to incorporate in a state whose laws favor the corporate form of business organization, and Delaware is one of those states that do. Accounting for stockholders' equity follows the provisions of each state's Business Incorporation Act. So, as you can see, it's very state dependent. All right, components of stockholders' equity. Here, as I'm sure you know by now, assets equal liabilities plus stockholders' equity. And if we change the equation around a little bit, assets minus liabilities equals stockholders' equity. All right, here we'll take a look at how that is presented. Paylocity Holding Corporation. Here we've got our preferred stock, and we show the number of shares authorized, no shares issued and outstanding, so we have not sold any preferred stock. Corporate common stock had a tenth of a penny par value, and they've sold 155,000 shares, and that was authorized, and 53,792 that were issued and outstanding. So we have two pieces of that, the par value times the number of shares issued, and then the number of shares issued times or less the total amount of money that we received. So these two pieces represent the contributed capital along with preferred stock. Key terminology here, contributed capital. Now, earned capital is comprised of the retained earnings. And as you remember, retained earnings starts with beginning retained earnings. We add any net income, we subtract any net loss or dividends. And this is a number that's representative of all of those components since the inception of the company. But we have a new term here called accumulated other comprehensive income, 675. So you want to be sure you understand that going forward. We'll talk a little bit about that here in a second. So here's our contributed capital, paid in capital, the total amount that's paid on common stock, and it's comprised, as I mentioned, the par value of all the outstanding stock and the additional paid in capital. Earned capital, as I mentioned, retained earnings represents the earned capital of the company. Now here, key definition, accumulated other comprehensive income. The aggregate amount of the other comprehensive income, and it includes unrealized gains and losses on available for sale debt investments and certain derivative transactions. All right, so characteristics here. Voting, your right to vote in the election of the board of directors if you're a stockholder. Residual claims. That means the owners are paid with assets that remain after all the other claims have been paid. The preemptive rights, the right to acquire a proportionate share of new issues of stock, and so they can keep their constant percent ownership. Term, that's the common stock, usually perpetual in nature, that generally doesn't have a maturity. and then the right to receive dividends. That looks like a good place for us to stop this video, and when we return,